Hi everyone. So far we have touched on the three big themes: value chain analysis, cost driver analysis, and strategic positioning. What we are going to do here is really compare and contrast conventional cost management analysis and strategic cost management analysis. Very important note here, in lesson A, which is conventional cost management analysis, we are going to crunch a few numbers, and in lesson B we are going to do something similar. But you are going to see is what you are going to see is a very different conclusions. In lesson A and this lesson B, on the same case study, you are going to reach out, to get to different conclusions. That doesn't mean that strategic cost management analysis is better than the conventional cost analysis, and vice versa. In fact, the key insight from this particular lesson, 3A and 3B, is for you guys to get a sense of the approach and then understand the strategic cost management analysis. It is really held here to augment, conventional cost management analysis. It's not meant to replace it. So please keep that in mind as we go through this particular case study. Again, a quick warning here, a lot of numbers is what we are going to look at. And what I need you to is please don't be anxious. And now we are not interested in the mechanics or having you go through tons of Excel documents to crunch numbers. In fact, a lot of you will have ample experience when you go into your particular employer and other classes. This is really meant to showcase the concept. The case itself, again, please do read the textbook for more details, but at a high level, we have a premium market manufacturer, so Baldwin Manufacturing Company, that makes high-end bikes with a lot of customers and dealer loyalty, and they are in a declining industry, so they have been approached to be a supplier to a chain called High Value Store Chain. So where they've been asked to is basically build a cheaper low-end bikes for the normal user. And here is more details on Baldwin. You have a declining industry, and this company thinking about potentially repositioning themselves and also supplying the low-cost vector in a particular market. And what High Value Store is instead of Baldwin bicycle, let's call the new line that you are going to only make it for High Value Store, and they are going to call it the Challenger. The other big insight here is Baldwin is only operating at 75% of capacity, so to them it's like, wow, it's an interesting opportunity in new market. We are not even fully utilized in terms of our factory. So there are three conditions here. Inventory management is the first condition. That High Value said is they would like to have an inventory on consignment for a long period of time, for 4 months. Not very unusual in this industry, so they always push to the supplier to hold on to the inventories to the last possible date. Low cost bike is the second condition. Again, it's really intuitive. Branding in appearance, again, to strip away Baldwin and re-image that as a brand called Challenger. No presence of Baldwin should be felt on this particular bike. Seems like there is some tweaking that needs to be done in terms of manufacturing line, but the costs aren't that substantial. Before we go into the actual crux of the problem, I'm going to give you a little hint from the chapter, and that we're just going to look at the financials really quick, because the financials paint an interesting story. Different people like to group these financial metrics differently. We've seen leverage metrics, profitability, metrics. Later on, we'll touch on the DuPont analysis. The idea here isn't necessarily to get stuck on a particular what the actual number should be and what categories of financial ratios you can construct. You are sure that you guys can do that analysis really well. You can definitely provide more insights, but for our discussions we have just broadly put it into three categories: profitability, stability, and working capital. Now, what does profitability mean? How well are they doing? Well, we are seeing really thin margins, only about 2.3%. The gross margin is fairly healthy, around 26%. That's kind of thing what we expect in manufacturing. Earnings before taxes to sales again is very low, 4.4%. It seems like they lose about 22.6 just selling general and administrative costs. Now, the obvious question is, why is that? Right? It could be that they are just spending a lot of money in advertising. Whatever the case might be, it seems like that particular cost is fairly significant for the company. And then you have a decent return on equity, about 8.2%. This is not your high stock like a Google or any other technology firm where the returns are 30 to 40%, but good nonetheless specifically for a manufacturer. When we look at the stability factors, not heavily levered in the grand scheme of things, 50%, very common in manufacturing in industry, because you have collateral to these, for example, like factories, buildings, that you typically own those, and you can put up as a collateral, so you should get a lower cost of capital, that is lower interest rates when you borrow, as opposed to going to an equity investor, essentially Wall Street types of basically raising capital from public in terms of equity. Current ratio, assets exceed liabilities, that is current assets will exceed the current liabilities. This percentage is greater than 1 or 100%. Now that's a good thing, it's a healthy sign, but look at the coverage ratio. Now you have to come up with a lot of money to cover your short-term debt with cash, and you pay literally 768% this year, and there is no way you are going to generate that cash unless you do something drastic, like selling a factory or doing something fundamentally unusual with your company. And what you would have to do is really refinance. And what from a risk standpoint is your ability to take risk is fairly low. Think about it, you are going to a bank and you are up for negotiations on a loan. The last thing you want them to do is to have them challenge any particular business strategy that you are pursuing. A very important thing to keep in mind, we'll come back to it in lesson B. Working capital metrics, continuing with DSO and DSI. Your DSO is 45 days and your DSI is 125. Inventory is held, what you can deduct from it is inventory is held for a significant amount of time. And again, the two themes that we're stuck out here is, if you like Walden's financials, high working capital requirements seems like a very traditional sales cycle. It's not like just in time or anything, and a big risk aversion because of low profitability and high debt that is due this year. Over the next few slides, there will be again, some calculations Please don't focus on the numbers. The key here is to focus on the fundamental difference between cost analysis and conventional, in the conventional sense, versus strategic cost management. There are three buckets in conventional cost analysis when you think about it. The first one is the manufacturing cost, the second one is working capital requirement, and the third is the opportunity cost. This is something you guys may have already been exposed to. This is basically what a revenue minus all the different types of costs that you are going to incur to put this particular product together. Working capital requirements, whether you are launching into a new business like this where there is a high working capital, there is a mass that you need to borrow essentially to build that inventory ahead of the life cycle. So there is always going to be an additional cost from a working capital standpoint. Again, a bigger problem for a mid to small size companies where they don't have a lot of cash on their balance sheet and there's a big opportunity cost. One thing to keep in mind always, pay attention to the opportunity cost. This is something that you are going to be tested during the midterm. So just don't think about what you see, also think about what you don't see, which is sales or opportunities or profits that essentially you missed out by pursuing this particular project. The first thing that the authors do in any fundamental cost driven analysis is every time you see something called a fully loaded cost, it includes anything and everything to make a unit. People love translating things on a unit basis. So in this case, it is $83.9 per bicycle. That's your unit cost. But what you are going to see here is part of the overhead, about 40% is only variable, and the rest 60% is actually fixed overhead. And what you should really think about when you get into a new project is marginal cost analysis. That is, what is the incremental cost of making a product? So the best way to do is to strip out that fixed overhead cost and only look at the variable cost, because that's ultimately what you are going to be evaluated on a going forward basis. So 69.2 is really your projected cost on a marginal basis. What we are doing here is to capture the cost from conventional cost analysis standpoint. So some of the assumptions that are already here is this, where it can get very frustrating for a few people because there is no rounding in here. So one of the estimates is about 5,000 bicycles are about to be sold, 4,000 of which have to be held back simply because of inventory requirements going forward. So direct materials is about 39.8. Going back to this previous slide, again, the direct materials is 39.8, and what we have done here is just rounded up to 40. There is 4,000 bicycles at any given point. So high value estimates 25,000 per year. You want to have at least 2 months of worth of material. Your DSI, that's the amount of inventory, or your inventory conversion cycle is about 125 days. So you have to get all the raw materials in your factory and enough of it so you have an adequate amount of finished goods. That's 4,000 down here, and so there is work in progress. So there is a certain percentage of it that your bicycle that is in the middle of the manufacturing cycle. And what we have done here is basically said it's 100% direct materials, again, that $40 plus the 50% of labor and variable overhead, because at any given point in time, half of that particular bicycles may be complete. And finally, you have finished goods at 69.2, was this on the previous slide. The author simply rounded it to $70 right here to make it somewhat convenient. Then you also have finished goods on consignment. Again, a big cost here. If you think about it, they just need to put like 4,000 units in some warehouse in high value till it gets sold. And then you have accounts receivable, which is going to take about 45 days for high value to pay them on these bicycles. And lastly, accounts payable, you have here, it goes in the opposite direction, because you know what's happening is you have your suppliers giving your materials and you are going to pay them later. Again, please don't focus on the ins and outs and the mechanics of how we get to the bottom line of the 595, which will be rounded to 600 in a second. The key takeaway here is whenever you do project, there is going to be a working capital requirements. Now, this number can fluctuate very drastically depending on how you set up your manufacturing process. Again, don't focus on this, which is basically 955, 92, 600 numbers. Take it as a given, and this is the working capital requirement for this particular project. Now, that's in a conventional cost analysis environment. Lastly, what we do here is to calculate the weighted average cost of capital. This is again to get a cost of what's really costing us to borrow. That is 600,000, specifically 595,000 to support working capital. So basically, the debt to equity ratio is here is 1 to 2. So 1/3 of the asset are financed by debt at about 18%. And then there's a big tax shield of 50% because tax rates where this company is really high. And then equity is about 15%. And when you combine these two, you get about 13% cost of capital. So again, don't particularly focus on the mechanics on how to get to 13%. It's rather the course of the finance, but that's your opportunity cost right there. So it costs you another $78,000 to get into the business of doing this. The cost per bike, again, taking that 78,000 and dividing it by 25, it can go anywhere between 3 to 4. So the book is suggesting about $4 a bike is the additional cost that you would incur to manufacture for high value store. The opportunity cost is a difficult one to assess. The authors have actually chosen to exclude this, and what this is really trying to do is to say, by manufacturing for high value, are you losing out in terms of existing sales channels? The average price for non-challenger is $110. The average cost again for non-challengers is $66. So the marginal benefit is $44. And the lost sales from challenger store from making challenger bikes is about 3,000. So the lost profit here is 44 times the 3,000. That is $132,000. And now the authors excluded this. And why did they do that? Number one, you are operating in a declining sales environment, so even if you want to sell those additional 3,000 bicycles, you really can't. And the second is the authors make a very interesting assumption here, which is that if Baldwin doesn't manufacture for high value, someone else will come in and they will produce it. So what's going to happen is they are going to lose these 3,000 bikes anyways. So and that's the main reason why they kept it out. So it's a very complex picture in terms of opportunity costs, at least in this particular case. In future cases, in this particular case, there is an opportunity case you can probably calculate fairly quickly, even in conventional cost analysis. That's something you would consider. And that's the big takeaway from this particular slide. What we have done is you have a revenue, and the assumption that they have taken is it's going to take Baldwin to sell these Challenger bikes about $92. Now you have $69 per unit in manufacturing cost. Then you have a working capital requirements about $100,000. Then there are opportunity costs disregarded in this particular instance. And the P&L for this new Challenger project looks really attractive. You know, if you look at it, because you have a gross margin of $23, and you are assuming you are going to sell 25,000 bikes, so that's how you get to gross profit of $575,000. Assuming the tax rate is still 50%, again they are in a high tax environment, and then take out your incremental cost of working capital, just estimated to be $100,000. Again, that's 13 times whatever the working capital requirement assumptions that you make, and then basically you're generating $187,500 in marginal profit from Challenger on your total investment of $600,000. So that's an ROI right there of 31%. And profitability on return on investment looks like a great project, and profitability or return on investment that you made is really much higher than your own return on equity, and you are generating with your current business. So from this perspective, it looks really attractive. Now, someone will say, hey, this is great from a net present value concept, a good project, and we should go for it. Now, we are going to end the lesson with a smile on your face as management and with a high degree of confidence, but I think the question is going to come up is, if you were to see it in another lens, a strategic cost management lens, what would that be? And that's what we are going to do in our next lesson. Again, a lot of reading for you guys. Please go ahead and go through that particular chapter 3 in the book to really sink your teeth into the case study. We are not going to do a problem in this particular lecture, but I hope that in the next lecture is going to be more engaging and interesting for you, and hopefully something new for you guys that we are going to see. And until then, until next time, have a good one. I will talk to you in lesson 3B.